Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin. I am the Chief Currency Analyst here at HYCM. I'm going to be taking you through the next hour, looking at what's been happening in the market and looking ahead to what market moving events are coming up. Just before we really get going into the webinar, just going to say hello and greet people. So just see folks who are coming in. Hi Sammy, Sahel, Van, Mohammed. Good to have you guys on board. Let's see who else is coming in. Yeah, okay. Just as folks are coming into the webinar, just going to go through this important disclaimer just to explain that as we're going through and looking at different market setups, different potential entries or exits, the whole purpose of this workshop is to see how to make trading decisions for yourself. So what isn't happening is this isn't a trading signal service or giving advice or recommending various trades. Instead, the whole purpose of this webinar and workshop is to help you make decisions for yourself. And so you can see my thinking and my rationale, the sort of thought process I have as a professional trader. So you can see, looking over the shoulder of a professional trader is really helpful to see, and that's what we're providing in this workshop. Now, first of all, let's look at the outline of the session ahead. Now, if the special topic that we're looking at today, okay, hi guys, hi Farouk, hi Lililia, good to have you on board. If you look at the special topic for today, this is what we'll be covering towards the end of the workshop. And this is something called expiry levels. And expiry levels are large options that are in the markets. And these large options aren't entered in by retail traders. These are institutional options and we know where they are in the market. And so I'm going to show you how to look at those option expiry levels, explain how to use them in trading, and then also show you where to access them. So we'll be doing that at the end of the workshop, and that will be the special topic for today. Each time I like to have one special topic. Looking ahead, we now see the handout for the session. So if you go to your handout section, which is on the right-hand side of your GoToWebinar control panel, you will see a handout, and it says Workshop Guide April the 2nd. And if you click on that, you will have a workshop guide which looks like this. And that's the special topic, where to access expiry levels. And then we have a various number of titles on this sheet. We have looking back, looking forward, looking at the charts, looking at your risk, and looking at the outcome of your trade. And we're going to be going through this sheet in order to help you guys know the process for making your own decisions. Okay, that's what we'll be doing. Also, if you would like any other special topics looked at, please email suggestions for topics to myself here, giles.coughlin@hycm.com. I provide these webinars and workshops for HYCM, and if you email me, then I can suggest and I can run certain topics for you. So if there's a topic you really want to know, maybe there's something you really don't understand, or there's an area that you're finding confusing, well, just email me and that topic, and maybe we can cover that in the future. That would be really good. So the first thing to do now as we get into the webinar properly is turn to your handout. And when you turn to your handout here, this is your handout. This is what it should look like. And for those of you who are just joining us, that can be found in the handout section. That is on your GoToWebinar control panel. And if you just click it open, you will see a virtually identical sheet to this. And the idea of this is that you print it out, have it by the side of your desk, and you can refer to it each time you trade. And I've chosen these 1, 2, 3, 4, 5 topics very specifically because this is what I feel kind of gives you a good overview of how to make decisions when you're trading. Okay, very crucial categories. Each one of those, 1, 2, 3, 4, 5, is very important, yet it's able to be fitted on one piece of A4 paper. So you can print it out, leave it by your desk, leave it by your computer screen, and refer back to it each time. I know that some people have found that helpful, and I certainly, this is what I do every time I trade. I'm using this principle, and that's just become internalized within me now. Okay, so that happens automatically for me. But when you're beginning, have it printed out and you can refer back to it. So the first thing we're going to do, you guessed it, is we're going to look back. And we're just going to go through the sections. I haven't done this for a while. This is what we're looking to do. We're looking to identify recent sentiment by reading up on the last 2 sessions of market activity. Okay, that's the thing. As soon as you come to your desk, you want to think to yourself, what has been happening in the markets? And what mood is the market in? That is all sentiment is. It's like the mood of the market. And the way you identify the mood of the market is you read up on the significant events in the last 2 sessions. Now, today's a really helpful example because we're going to see there's been some market moving events over the course of the last couple of sessions. So it's going to be easier for us to see what mood the market's in. And what we're trying to do as we analyze the move, we're not just trying to see, what events have happened for the sake of what events are happening. We're trying to understand what's the key market sentiment. There's lots of sentiment always bubbling around. There's this news event, there's that news event. But what's the most important? What's the key sentiment? What is really driving the market? And can you summarize that sentiment in a sentence or two? We want to try to find the main theme, and that operates as a kind of, the main line that will take you through the trading session, okay? So we're going to do that now. We're going to spend some time looking back. And the last 2 sessions, remember that the market is divided into 3 every day. It starts at about 12 o'clock GMT time. It starts with the overnight Asian session. And that runs from 12 o'clock GMT to about 8 a.m. GMT. That's the Asian session. We've got Japan, Hong Kong, those major Asian markets are open at that time. Now that's the quieter time of the market. We then wake up about 8 a.m. with the European session. And that 8 a.m. to 5 o'clock in the afternoon GMT time is the European session. That includes Frankfurt, Berlin, London, all included in that session. And then about halfway through the European session, at about 1 o'clock GMT time, we have the start of the US session. And the US session runs through all the way to 10 o'clock GMT, and then the whole process starts again. So whatever time you're listening at, so say if you're in, I know a number of you guys are based in Dubai. If you're in Dubai, you're plus 4 GMT time. Plus 4 hours GMT, and so you just need to think, well, hang on, so when I wake up in 6, so I wake up 6 o'clock, that's about 10 o'clock GMT time, and so I'm halfway through the European session, and by the time it gets to sort of 12 o'clock, what time is it? By the time it gets back to 12 o'clock your time, about 12 o'clock your time is plus 4 GMT, 12 o'clock your time is about 8 a.m. 7. Yeah, I'm getting a bit confused here. But you've got to think to yourself, whatever time you are, which session is an action? Okay, which session is an action for you when you wake up and you get going? And the different sessions have quite a lot of different characteristics. So the Asian session is much quieter, smaller ranges. So you need to know which session you're trading in. So we're going to look at the last 2 sessions of market activity. So we're going to look at the European session, which we're halfway through, and we're going to look at the Asian overnight session, which is just happened. Okay. So when we look back, there's one key event that's really been moving the market. And this was an event that I flagged up at the start of the week on my weekly email that I send out to HYCM clients, is to watch out for Chinese PMI data. Now, this is the Purchasers Managers Index, and this is a good indication of how purchase managers in China, how they're looking for their manufacturing and they're looking for their production. And this PMI data gives you a really good indication of how growth is going to be impacted in the economy. And the Sunday overnight reading was really good for the Chinese PMI data. Now, the official PMI data, because the Chinese data is split into two different types. There's the official PMI data, which is on the screens for you now, and there's the private PMI data. Now, this official PMI data tends to survey the larger companies which tend to receive government subsidies, government support. So these are the bigger fish, as it were, in the pond. And what was expected was 49.6, but the official figure was 50.5. So it's gone back into expansion. So that's a good reading, and that's an optimistic reading for China. And the services sector was also up 54.8 versus 54 expected. So this is a sign that Chinese stimulus is starting to work. The Chinese government was concerned about the slowdown in growth this year. It's sort of hitting 6.4, 6.8%, I think they're expecting, which by developed countries, that would be a fantastic figure. But for China, which has been like a developing country, that's a shrinking back of their GDP growth. So the Chinese government have been trying to stimulate growth, and then the falling in the PMIs have been a concern. There's been the US-China trade war in the background, and this is the beginning of a sign that the Chinese stimulus measures are working. Okay, so the PMI data was good. Now, this is the CAC-SIN PMI data, which is the private data. This tends to be a survey of smaller and medium-sized businesses, and this was 50.8, which was a uptick of 0.8 on the expected reading of 50.0. So that was two very good readings, and the market responded by being in a much more risk-on situation. Now, for those of you who have been attending my workshops for some time, which currencies would you expect to appreciate in a risk-on environment? See if you can tell me this using on the questions. The idea of the workshop is that this is a bit of, yeah, Farouk, this webinar is being recorded, and Nadir, no problem. So on the global sentiment, you could have seen this, and which currencies would you have expected to appreciate? I'm going to give you a second to answer this. Oh, well done. Excellent work, Chibivan. Excellent work, Olufemi. That's very, very good. Well, we're in the good news is two members have been able to get the correct answer very quickly. So well done to you guys. And which currencies appreciated was the Australian dollar, the New Zealand dollar, and the Canadian dollar. They're known as the commodity currencies, and particularly the Australian dollar and the New Zealand dollar tend to appreciate on a risk-on situation. And again, to remember, what's good for China is good for Australia. So the Australian the country of Australia, about 30% of their GDP comes directly from trade with China. So when China's doing well, Australia's doing well, and many currency traders will trade the Australian dollar as a proxy for Chinese data. So, for example, you might think, okay, well, some Chinese data is coming out. What good is that for me as a currency trader? Well, the Australian dollar is a good currency to trade Chinese data off. Okay, so you know, if you go back, you can see at the start of the week, you would have seen the Australian dollar and the New Zealand dollar was being bid on this news. Now, the Australian dollar has been sold off since, and we'll explain the reasons why. There's some very obvious reasons why that's the case. So don't worry if you're a little bit confused at this point in time. Very good. Well done, Chibivan. Well done, Olufemi. Now, yeah, so that was the big. That's the big news that's really started off the week. Okay. Now we also had a speech by the Bank of Canada's governor, Polotz, and he was saying, you know, one of the key things, for those of you who just joined this webinar, one of the key things is currencies are driven by central bank policy. The reason we study central bank policy is because that gives us a clue as to which direction the currency is going to go in. So the governor of Bank of Canada is speaking. That's a very important event, potentially market moving. And he said the Bank of Canada is decidedly data dependent on rates. Now, last Friday, we had a really good uptick in the month-on-month GDP data for Canada. So it was just interesting to see what Pollock was saying. He says, we're not forecasting a recession. He says we may need to become accustomed to seeing curve inversion more often. That's obviously talking about the US Treasury yield curve inversion. I've covered that on two webinars, which I've done on the Monday. You can see the recording of that if you want more information on the inverted yield curve. It carries on about the yield curve. He says it's not helpful to focus on the neutral interest rate. It's not a target. Wishes market would not focus on neutral so much. The market is focusing so much on whether it's neutral or raising or cutting because that predicts and indicates the direction of the Canadian dollar. So that's why traders focus on it, and they always will. So unfortunately, Pollock won't be able to get his way there. Considers core inflation close to 2% a significant success. So he's looking for core inflation at 2%. That's what he's trying to achieve. Now, he also said, it says it's clear that the global economy is performing less well than we believed only a few months ago, and Canada is feeling the effects. So that's bearish. It says, in addition, our housing sector is taking longer than previously expected to digest the combined effects of stricter mortgage guidelines and higher interest rates. That's why we said at our last interest rate announcement in March that the economic outlook continues to warrant a policy interest rate that is below the neutral range to help the economy work through this downshift in growth and to keep inflation close to target. Recent economic data has been generally consistent with our expectation that the period of below potential growth will prove to be temporary. So in other words, what Pollock is saying is we're on the right course. He's saying we're pleased with the path we're taking, and so there's not going to be much move in the Canadian dollar on that kind of statement, because he's saying we're essentially no change, okay? We're just kind of as we are, but he has highlighted that he's data dependent. So that means as currency traders, we now know that data out of the Bank of Canada is going to be eyed very clearly by the Bank of Canada. So data is important to Pollock's. If it's important to the central bank governor, it's important to us. Okay, we also had, and it's impossible to miss this event that's going on in the market, and that is UK Parliament. It rejected all 3 Brexit options last night in the indicative votes. So there was a series of 4 options that the UK Parliament might go down, and they rejected every single one of them. I mean, I've seen a funny meme on the internet, and when Britain is asked to choose on different options about Brexit, all it says is no, 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 and no. And obviously, I'm a British citizen. I'm living here in the UK. And there is a deep sense of frustration within the UK. Why on earth we haven't been able to sort out and finalise a Brexit deal? And that frustration is really tangible and is really working its way through the entire population. And last night, again, all 3 Brexit options voted no. The closest vote was on motion C. Now, that was only defeated by a few votes. Now, I'm going to explain to you guys what's important. Now, motion C was for a customs union, and that was 273 voted for, 276 against. So the vote only lost by a few votes. Now, this motion C is known as a soft Brexit. And it basically means that UK will stay in a permanent and comprehensive customs union. And it's very similar to how Norway relates to the European Union. So this soft Brexit was nearly voted through. Now, these indicative votes aren't binding. It didn't mean that the country would have to follow what these votes are saying, but it would show a majority. And if there was a majority in the UK Parliament, then potentially Theresa May could say, okay, well, that's what the majority of Parliament want. Shall we try and vote on a customs union as a permanent solution for Britain? Okay. Now, a soft Brexit would be very positive for the pound, okay, because it means it's less stress, less division, less bureaucratic and technocratic decisions need to be made with taxes and borders and different, complicated financial and political issues. A soft Brexit avoids those. So that would be very positive for the pound, and you can see the pound jump to about 1.3600 quite quickly if a soft Brexit was announced. So the interesting thing to be storing in the back of your mind, Parliament, the closest Parliament has got to a majority is with this customs union, soft Brexit. Now, the UK Chancellor Hammond was reported to tell the Cabinet on Tuesday that the Tories might have to consider another referendum for the British people, as an election would be too costly for the party in the country. Because Theresa May's in a problem here. If she can't get a majority in Parliament, then she's not going to be able to get the deal through. And so what she might say is, let's have a general election because we can't get an agreement through Parliament. We need to change the political order. The problem with that is obviously you're going to have a new government at a very difficult time, and the Conservative Party will inevitably do badly because they've been handling this Brexit withdrawal process, and a lot of frustration will be taken out on them. And there's a growing consensus now within the UK Cabinet that they should reluctantly accept a customs union if PM May's deal loses in a final round of votes expected on Thursday. So in the backdrop, the UK Cabinet is saying, well, if we can't get Theresa May's deal accepted, then we should probably accept a customs union. Now, remember, a customs union is a soft Brexit, and that would be bullish for the pound. That's why the pound is still being gently bid. It hasn't been sold off as hard as you might have expected on the back of all those votes being rejected, because at the back of the market's mind, it knows that UK government doesn't want no deal. No one wants no deal in the UK. So therefore, the weight of political will is to achieve a vote, is to achieve a deal. So that's why the pound is being a bid. Now, all that can change, obviously. There's nothing guaranteed in the market, and even if everyone in Britain wanted to do one thing, the other outcome is still possible, because that's life and that's trading. However, that is the situation that is helping to underpin the pound at the moment. Now, these are the options that the UK government now has. Okay, so the thing is, they can have a third attempt at getting Theresa May's deal through. Okay, so Theresa May's deal has been rejected twice now. It's opposed by the DUP, which is a small part of the Conservative coalition that has kind of it's based in Northern Ireland, and their concern is there's going to be a Northern Irish border between Southern Ireland and Northern Ireland, and it's going to effectively cut Northern Ireland off from the UK mainland. That's the concern with Northern Ireland. That's why the DUP won't accept Theresa May's deal. It's because of the Northern Irish backstop problem, to do with what happens with that border. Okay, so Theresa May has another problem, is that the Speaker of the House of Commons, John Bercow, has said that he won't accept Theresa May bringing her deal to be voted on again, because he says you can't keep bringing the same piece of legislation to the House. You can't keep, it's a bit like nagging, isn't it? You know, imagine if you've got children, or imagine a child. Can I go to the park, Daddy? Can I go to the park? Can I go to the park? Eventually, you keep nagging. If they keep nagging you enough, eventually you'll take them, okay? And so that's what John Bercow is essentially saying, is you can't keep asking the same question over and over again. So there's problems with Theresa May being able to easily bring the deal to the table again. Right. Now, the baseline scenario is, at the moment, there will be a hard or a no-deal Brexit due to happen a week on Friday. Now, if this happens, we will be looking at the pound falling to 1.20 in no time at all. Okay, this is a hard no-deal Brexit, and it is due to happen a week on Friday. So that's a very real risk for the pound. The other option now is a long extension. So what Cabinet might decide is to say, look, we can't agree on a Brexit solution, so we'll have a long extension. No one wants that in the UK again, and the problem is that if there is a long extension, that is going to be bad news for the UK, particularly because it just prolongs uncertainty. There's been a lot of lack of business investment in the UK, and that's been because of the uncertainties around Brexit. Companies aren't investing in the UK like they would normally, and even companies within the UK aren't expanding or taking on new projects because of uncertainties about Brexit. So no one's going to want that long extension. And the other one's a general election or another referendum. Now I find this quite interesting, another referendum. And now Theresa May has ruled that out, but obviously Philip Hammond was saying that maybe we should suggest that we have a referendum on which deal to accept. So to ask the British people about what deal to accept, or ask them another referendum. You know, Jeremy Corbyn is sort of teetered around the edges of wanting another referendum for all of Britain to say, do you really want to leave the EU? Now, if there is another referendum, and it's to do with whether Britain wants to stay in the EU or leave it, I don't think that will happen. But if it did, this is the current polls on leaving the EU amongst British people. Now, Britain did leave to leave the EU, but the view now on the polls is more than 50% would want the UK to remain within the EU. So it's switched. So certainly in terms of market expectations, if there was another referendum and it was on this question, do Britain still want to leave the EU, then the majority of people in Britain would remain. I think largely that is partly because of the hassle this has been trying to leave the EU. A lot of people just want certainty. They kind of want life to go back to how it was before. So that's that issue. And then the final option is a soft Brexit involving Britain staying within the custom unions. So I just want to go through the impact on the pound. Okay, if Theresa May's deal is accepted, that would be bullish for the pound. The pound would appreciate, again, up to about 1.36. If there's a hard no deal Brexit due to happen a week on Friday, then we see the pound go to down to about 1.20. Okay, there's a long extension. Again, we'll see the pound, depending how long the extension is, we'll see the pound rally on relief, but then there'll still be pressure to sell the pounds because the extension doesn't solve the problem. It just, as it were, prolongs the problem. If there's a general election or another referendum, a general election, I think, would see the pound fall because the prospect of Jeremy Corbyn and the Labour government getting in would be very bearish for the pound. So you'd see a big fall in the pound. General election. If there's another referendum, I think you're most likely to see an increase in the pound, depending on the question that's being asked. A soft Brexit, again, that would involve a increase in the pound, again going up to about 1.360. So the pound is undervalued at the moment because people are concerned. Okay, all the investment, people are keeping money out of Britain. The Bank of England isn't raising interest rates when perhaps they would. So that's the kind of concerns that there are in the market at the moment. So one of the things about the workshop is I like to help you guys make decisions. So we're going to look at the pound US dollar pair, and what I'm going to ask you is look at the charts and tell me where a key places to define and limit risk would be. Okay, so we're going to open up your demo charts. Let's have a little look. I'm going to open up my chart here for you. And I'm going to ask you, where would be a very key place to define and limit risk? Remember, that's always what we want to do as traders. We want to define our risk, limit our risk. So let's say that we're looking for prices at this point. Where would we want to define and limit our risk if we thought, a deal is going to get done in the next couple of days? We'd expect the deal to be done. Where would be a good place to define and limit your risk? Having a look at those charts. Remember, we use moving averages. We also use Fibonacci retracements. And where would be a really good place to define and limit risk? Have a little look for me now. Here's a clue. Where is price at the moment? I'll show you. This is the 100 moving average, the 200 exponential moving average, and the 50 exponential moving average. Price has been bouncing in between these technical levels, in between the 100, the 50, the 100, the 50, the 100, the 50, and the 200 there together as well. So price has been bouncing around those technical levels. Where would be a good place to define and limit risk? I'm going to give you 30 seconds to see if you can tell me where. There's a chart, it's on the screen. There's the Fibonacci level. Okay. Here we go. Now, looking at this chart, we can see that price is just rejecting that 100 and 200 moving average. See, price was brought up yesterday on the expectation that perhaps a deal would be done, that perhaps one of the indicative votes would be accepted and price was bought. Now, you can see that technically it's moved up into that 23.6 Fibonacci retracement level and sold off. Now, looking at the charts here, we see that it's sold off also on a pivot point. You see that pivot point there, 1.3200? It's sold off at a pivot point on the daily chart, okay? So here we go, here's the daily chart, the Great British Pound, and we can sort of zoom in, you can see price moved up into the pivot point and sold off, okay? So that was a key technical level. And also if you look on the 4-hour chart, you'll see that price moved up into the 200, 50, 100 exponential moving average, the 23.6 level and sold off. That was the initial down move there, okay? And now price has been consolidating and bouncing around after those votes last night. Now, if you were taking the view that actually there is going to be some kind of deal done, a good place to define and limit your risk would be underneath the 100 and 200 exponential moving average and the 38.2 level. So you could see a very sensible place to enter would be somewhere around this level here. So this is how you can see prices there. You just drag it down for a stop and putting your stop there. And you could have a very large potential profit target here at 1.36 if a deal that does get done. So you can see, looking at that chart on the daily chart, you can see, look, there is a potentially very good trade there with defining, limiting your risk, but with potential upside. Okay, that's a key place to enter there. Now, say you thought a deal is not going to get done, then you could define and limit your risk in a different way. Say you thought, well, okay, I don't think the deal is going to get done. You could sell and you could put a stop above the pivot point, okay? And you could be targeting down to these lower support levels. And obviously, if a deal wasn't done, you could get down to the 1.20 level. Now, again, this is not an invitation to trade. I'm not suggesting it, I'm not recommending it. I'm just saying these are the kind of decisions that we need to make when we're trading. How do we define our risk? Where do we limit our risk? How do we put this into perspective? Okay, so I hope you understand what we're looking at there. But obviously, the key, we'll look at some of the key factors we want to look at that will really move the pound on that. Okay, moving on to the Asian session, it wasn't just about Brexit, although you could be forgiven for thinking it was just about Brexit, the amount of focus we've had on it. We also had a very important meeting from the Reserve Bank of Australia. Now, the Reserve Bank of Australia had their rate meeting. They said the Australian labour market remains strong. There's been a significant increase in employment. So the unemployment rate is at 4.9%. They're very pleased at that. The vacancy rate remains high. There's reports of skills shortages in some areas. That means there's going to be stronger wages. The stronger labour market has led to some pickup in wages growth, which is a welcome development. Continued improvement in the labour market is expected to see some further lift in wages growth over time, although this is still expected to be a gradual process. So, okay, now, as traders, what we can see is that the Reserve Bank of Australia is focusing their confidence in the labour market. Now, what does that mean for us as traders? What potential opportunity does that give us as traders here? Okay, here's an extra question. What is the Reserve Bank of Australia focusing on in their rate statement? What are they focusing on? I've summarised some of it here for you. What are they focusing on? Nadir, excellent. You've got it exactly on the head. You've hit the nail. They're focusing on labour. So that means when the central bank is focusing on a particular indicator, how important will that indicator be to the direction of the currency? It will be very important, okay? Because as traders, we want to focus on what the central bank is focusing on. We see here the RBA rate statement, they're saying the labour market remains strong. Some of the market participants were expecting the Reserve Bank of Australia to be more negative and to be more bearish when they came to give their rate statement. Actually, they've been much more neutral and they've been more upbeat than expected. And they've been focusing again on the labour market remaining strong. Okay, so it wasn't as bad as was initially thought. Now, what this means is that the next labour data point out of the Reserve Bank of Australia will be very important for us as traders. We want to see it. Now, if the employment change was worse than expected, if it was a bad reading, what would we expect to happen to the Australian dollar? If it was a bad reading, what would we expect? Yes, Nadir, exactly. We'd expect the Australian dollar to go down because the central bank is focusing on it. If the unemployment rate was really high, you know, it went from 4.9% to say, you know, 5.5% or 6%, we know that the Reserve Bank of Australia would take that as a negative sign and would be more likely to cut rates. Okay, because what they've been focusing on, the strong labour market, seems to be under pressure or seems to have gone. So what we're looking at here in the rate statements, we're looking for clues as to where the future direction of the currency is going. Okay, and this was the RBA rate statement. So here's a quick question for you. Maybe you're new to trading, maybe you don't quite yet know where to find this. Where would you find the RBA rate statement? Where would you find it if you wanted to find it? Question. This is meant to be interactive, guys. Where would you find it? Yes, Nadir, Mohammed, well done. That's exactly right. You would find it on the Reserve Bank of Australia's website. Okay, and I'm just going to show you guys. Ooh. So all you do, you go to the Reserve Bank of Australia website. Okay, here's the website. Yeah, well done, Chibivan. That's exactly right. And you simply go to monetary policy. Click on the monetary policy. We're looking for statements on monetary policy. We're looking for 2019. And we're looking for March's statement. Let's see, that's February. Let's see if they've got. That's February. We want the latest one. I think it was on the home page. They haven't obviously put it into the thing. Here it is. Statement by Philip Lowe, Governor, Monetary Policy Decision. Here it is. So this is what you do. You look at it and you can see the most important information is often at the start and at the end. Okay. So they say at its meeting today, the board decided to leave the cash rate unchanged. Okay. Again, if they had increased interest rates, the Australian dollar would appreciate. If they decreased interest rates, the Australian dollar would depreciate. Okay, this is key to understanding the path of currencies. And then they go through all their explanation. And you can see what they're thinking about inflation, you can see what they're thinking about the GDP picture, and what they're saying often at the end they have an important summary, and they're essentially saying they're going to hold the stance of policy unchanged at this meeting. Okay, they judged it was appropriate. Okay, so this is where you find the rate statements. You find it on the bank's websites. Other places you can find. I'm a commentator and a currency analyst for forexlive.com as well, and they offer a very good service for retail traders, and it's free. So don't forget that service that is provided by forexlive.com. Let's just find out. There's my keynote. There we go. There we go. That's super. Okay. So sorry, just sort out my screen again. Just check you're with me. Yeah, so that's it. That's where you'd find it. So those of you, yes, Sammy, excellent. You'd find it on Economic Calendar as well. You can go to a website like Forex Factory, and they will often have links to it. The only thing that I would say to you guys is try to get into the habit of reading the actual rate statement for yourself. The problem with going to an Economic Calendar, Sammy, is that often what you'll find is an analyst's response to the RBA rate 8 statement. Now that's fine, and you should read them. But if you read the rate statement yourself, there's just no, there's no duplicate. There's no for actually reading the information yourself. It really goes in and it helps you. So make sure you do that. Now this was the reaction to the RBA rate statement. Now this was a good example of how difficult sometimes the rate statements can be, particularly when they're not that clear. Okay, so this RBA rate statement, it was expected that the Reserve Bank of Australia would be quite negative. They weren't as negative as expected. You see, they were more upbeat, as we've read, and you can see that the price originally appreciated 20 points, okay, on the release of the minutes, and then sold off quickly. See, there was this big whipsaw movement, okay, a range of nearly 35 points, okay, on the announcement, and that's because there wasn't a clear. It was neither clearly negative or clearly positive. Okay, it was kind of somewhere in between. The reaction afterwards was eventually selling off. So the settled reaction to the market has been that it was not as bullish as would warrant an appreciation on the Australian dollar, and there's still enough downside there. But that was the initial reaction on the Australian dollar. And the reason is it just wasn't clear cut. It wasn't like they went and said, okay, yeah, the situation is much worse than we thought. We're going to take longer to raise interest rates. That's an obvious sell. You just see a sell, okay? Or it's not like they said, oh, it's our situation's really good. We're going to be more likely to raise interest rates now than we expected earlier. Then you see the Australian buy. So what you're looking for as a currency trader is a reaction that is not expected. So get into the habit of reading the rate statement yourself. Asian bourses higher at the European Open. See, this was, apologies, I got a cough there. This was all about the PMI, positive PMI data. That is affecting global risk sentiment, how China are doing and how China and US are doing. So the PMI data was up for China, it was up for the US. So the mood, the global mood is up. Okay, the Nikkei, the Hang Seng, the Shanghai comp were all up on a Monday overnight. They were up last night, Tuesday, and the optimism on US-China trade deal, it's a good buoying impact into the market. The European session, nice little setup here I'll explain to you, and this is all to do with what's important in the market, okay? So Moody's credit rating on South Africa was confirmed at Baa3, with the outlook stable. Now, Moody had delayed the country's rating on Friday. It was due to be from Friday, but it was delayed. And the concern was thinking, oh, perhaps with the upcoming elections in South Africa, perhaps Moody is going to downgrade the South Africans' credit rating. Okay, their fiscal strength will be seen as poor. So today, during the European session, it was affirmed, and the outlook was said to be stable. So that was a relief, because now the South African currency is the ZAR. So when I saw this, this was the reaction here. Okay, as soon as it was confirmed, this is the US dollar ZAR pair, and this is the South African currency, and the South African currency strengthened immediately on that release. Now, I'd known this story. This is what you have to hone into the story. I knew that this was an issue, okay, and I knew that there was a concern that maybe Moody wouldn't affirm it, and that this outlook would be seen as risky or poor. But it wasn't. It was firm to stable. Everything's okay. So that was a relief, and you'd expect the South African currency. What would you expect the South African currency to happen? Oh, Olufemi, you can't hear me. Oh, that's not good. Can everyone else hear me? Can everyone else hear me? Oh, yes, okay. Oh, that's good. Olufemi, everyone else can hear me. So Olufemi, it may be a setting that you. I'll just quickly reply to try. Oh, Chibivan can't hear me. Okay, I don't know. Some of you can hear me, some of you can't. Try changing your settings. Right, I'm just gonna send a message to Chibivan. And okay, so got a bit of a problem here, guys. Some people can hear me, some can't. I'm going to carry on. I think it's just Olufemi who can't hear me, so I'll carry on. Okay, so what would you expect the South African currency to do when there was concern that it might be unstable, but it's suddenly affirmed as being stable? What would you expect the South African currency to do? Yes, Nadir, you'd expect the South African currency to appreciate. And Sammy, if you mean you'd expect the US dollar ZAR pair to drop, you'd be correct. So yeah, so the US dollar ZAR pair would fall. Okay, that's because the US dollar would fall against the ZAR. That's what we're expecting. So you see, this is how I go about trading. So I knew then. Just sorry about this. There we go. Now here's my entry. Okay, this is from my trading from my hedge fund account. What happened is I entered as soon as I heard the news. So there was the big candle there. That was the quickest I heard the news, and that was using a live squawk. Okay, so someone obviously heard before. Someone just totally focused on that event. Now this was the time I heard, and as soon as I heard, I trailed the stop down on the 5-minute chart. I just trailed it behind each candle, and I took my profit. Was taken out there. Okay, and that's the way I did it. That's just an example that would be helpful for you guys to see. And then I wasn't interested in trading on a retrace. I just wanted to take the spike. It's not a pair I trade really, but that situation was just worth trading. Right. Okay. In the European session, we had Bitcoin spiking up by more than 15%. Huge jump of Bitcoin. I asked a friend of mine who's been working in Bitcoin for years, and I said, was there a fundamental driver to this? He didn't know of one. So this seems to be like some kind of technical buying that was taking place, but that was a huge move that's taken up. European session, we had the EU chief Brexit negotiator. He was on the wires saying the same old things it's been saying for a while. No deal Brexit is more likely, but still hopes to avoid it. Says the EU can accept a custom union and new relationship akin to a Norway deal. In other words, they're saying that customs union deal that nearly got through Parliament, he's saying we like that. So that's positive for there. So the only way to avoid a no deal is for positive majority in the UK Parliament. So just that's it. Bear with me. I was just unplugging a. Oh, hang on. Let's see. Okay. Oh, okay, Olufemi. Like that, at least that explains why you couldn't hear me. Yes. See you next week. Just that was why Olufemi couldn't hear us. He's had network problems. Okay, that's great. So this is the EU saying we can accept a customs union, and the only way to avoid a no deal is a positive majority in the UK Parliament. So nothing really new from him. We had CPI data out of Switzerland. Because time is short, I won't labour on this. Not particularly important. Slightly better than expected inflation data, but well short of the 2% target, so nothing to get excited about. And then we saw that Theresa May saying doesn't want a long Brexit extension, so that's what she's ruling out, the long extension. Says that Barney's comments are nothing new, that's true, and also saying that cabinet ministers will discuss result of indicative votes and the best way to proceed. So Theresa May still trying to work it out. We had US dollar leading on the day, New Zealand dollar the least strong currency of the day, had the Australian dollar the second weakest, that was after the RBA rate meeting. US 10-year yields were down, gold was flat, crude was up 0.8% on concern of Venezuelan supply issues and new waivers on Iran, and Bitcoin was up 16%. So, you know, and is now pushing over the $5,000 handle. European session was full of rumours on Brexit. Expect those rumours to carry on. Though I have to say, the pound is still being bid and supported. The hope is a deal will be done. It's still hopeful there. Yeah, quick look at the equity markets. European equity markets really rallying strongly, +2%. The DAX UK +2%. IBEX 1.73%. Italy's FTSE doing fantastic. So good. Good results across the European bourses. Looking forward, we've got some Australian retail sales out, and we've got some PMI data out of for the pound tomorrow, and non-farm employment change, and we've got the crude oil inventories coming up tomorrow. So we always want to say what's going ahead. So nothing particularly market moving, only the retail sales potentially. And looking at the charts, we always want to develop a bias for certain currencies, okay? So today, what currencies would we have a bias for? What currencies would we be looking as strong and as weak? Give me some, type in the thing. That's what we want to do. We always want to find a bias. Yes, we've got some strong strength in the US dollar. Yet there is some euro weakness, and that's been from data out of the Eurozone. We had that very weak German PMI data that's been constantly weighing on the euro. What about the Australian dollar? Strong or weak? What do we expect? Yeah. So, excellent. Tribhuvan, Nadir, Sami. Excellent. Well done, guys. So, we've got Australian dollar weakness, US dollar strength. So, we'd look at which pair would we look at trading? That's it. So, we'd be looking at we'll be looking at Australian US dollar shorts. Okay. That's it, Tribhuvan. That's exactly right. Now, if you look here, here's the chart. Okay. Here's the Australian US dollar chart. Here's a 15-minute chart. This was the data point out of the RBA rate statement. We had the weakness. Then we saw price retrace up to the support 2 level and sold back off to this level here. You can also see that that is the 38.2 Fibonacci retracement level, and it's a good places to have entered. Would it could have been entering at the support level, could have had a stop above the 200 exponential moving average, maybe even above here, this other pivot point, and you could just see that this would be a sensible place to have joined the Australian US dollar sell. Yeah, New Zealand dollar has been very weak as well, and that is a weak level. What I like to focus on, Sammy, is if you notice, you've got some auction levels coming out for the New Zealand dollar. So tonight we've got a commodity price, and you've got the GDT dairy index. So I would be just staying clear of the New Zealand dollar when you've got those data points. The dairy price index can move it, so that's why I'd be just steering clear of the New Zealand dollar for now, especially for a short-term trade. Okay, I just want to be looking ahead and I see, okay, got the GDT price index ahead, Sammy. But that has been a weak currency. Always I like to find a reason for the weakness, or else you can sometimes just be hit with technical selling. So that's why I prefer the Australian US dollar sell. Now, the special topic I wanted to look at was where to access expiry levels and how to use them in FX trading. Now, we haven't got as much time as I'd liked here, but basically options are contracts that can be purchased by paying a premium amount for the right, but you don't have the obligation to buy or sell an instrument at a specified price. So it's often used to guarantee prices, okay? And so these options, you get a buy option is a call and a sell option is a put. And the premium price varies depending on where the current price is. And these option levels can be very large, okay? And yeah, reaction to the Australian dollar budget. No, there wasn't that much reaction to the Australian budget at Nadir. It was slightly worse than expected, but there wasn't particularly anything moving there on the Australian budget. So that's a good spot. That wasn't particularly highlighted by the market, but excellent for being aware of it, because easily it could have moved the market, Nadir. Very good. Now these option expiry levels, don't worry if you don't understand them, okay? The technical explanation is quite difficult to understand. The key thing to realize is that there's these expiry levels that are in the market, okay? Now, when you see an expiry level, the ones to pay attention to are the ones that are large, so the ones about $1 billion, okay? So anything above $1 billion you want to look at. And so here you see in the euro-US dollar pair, we've got like a option level of 1 billion at 1.20. At the euro pounds, there was 1 billion at 0.8550. The US dollar Japanese yen had a 2.4 billion expiry level at 111 to 11120 on the US dollar Japanese yen pair. And basically, take a quick screenshot of these and you can have a look in the market how price reacted around these levels. Now, these levels expire at 2 o'clock GMT time. And when these levels expire at 2 o'clock GMT time, what you tend to see is it tends to work as like a magnet to price, okay? And price is pushed and pulled towards these levels, okay? So first of all, you need to study these. There's not an exact science to them, but if you're aware of them, you'll see how they move price. Yes, where can you find them? Any link? Yes, I will send the link to you all, because what I do is I post these on my Twitter feed each morning, okay? So you can see here, I put this morning, 7 hours ago, I put up large expiries seen on euro US dollar, pound US dollar, euro pound, and on dollar yen, okay? These are the levels. So if you go to my Twitter account, you will find these levels, okay? I'm just going to send that to all of you. Right. And I will try to put these expiry levels up each day, okay, for your benefit. And then look at how they work, and hopefully in future times I will be able to talk about them a little bit more. That's all we have time for today. Don't forget the offer that we have at HYCM. If you deposit $1,500 in your account, you get a 1-hour coaching session with me. $3,000, you get a 1-hour coaching session plus an hour review. And if you deposit $10,000, you get a 2-hour coaching session with me, one-on-one, 1-hour trading follow-up, and 1 week's VIP support. So don't forget, these offers are here. Guys, thank you for your participation. Great to see a number of you really developing and growing. And I really hope you have an excellent week. And don't forget, we're back again on Monday. Now I'm not here. I'm in Dubai on the 8th of April. So I won't be back now till the 15th of April. So I'll be away for 1 week. I'm in Dubai leading a trading course. For those of you who can make it, that's great. Those of you who can't, no worries. And I hope to see you guys back on the 15th of April. Guys, you take care. I hope you've had a really good time. Thank you for all your input. Thanks again, Tribuvan. You're welcome. Thanks for your input too. Yeah, have a good week, guys. Thanks very much. Goodbye. You're welcome, Nadim.